6 reasons the housing market could crash in 2021. Unlike in the stock and other markets where people understand the waves of rising and falling values, few understand or accept these principles also apply in the housing market. Few homeowners would be willing to accept or rationalize that their property value might go down at any given moment. This assumption can also be attributed to the stable nature of the housing market, where crashes are relatively less in comparison to other markets. This stability can be connected to the high transactional costs of buying and maintaining a home, thus discouraging speculative behaviors that might be witnessed in other markets. Although the housing market is less susceptible to volatility, several market crashes have been witnessed in the past. The one that comes to mind for most people is the 2008 crisis that burst the housing bubble of the previous 2 years. This obviously had devastating effects on the global economy. Domestically, property companies, investors, and homeowners felt the effects of the crash more than anyone else. Unfortunately, these parties should be preparing for the next housing bubble burst in 2021. Indications are all over, and this piece seeks to provide 6 reasons why the housing market could crash in 2021. 1. Property market bubble burst. Most asset crashes are traceable to bubble bursts. In 2008, the economy crisis was attributed to a bubble burst. The phrase is so common that it attracts multiple explanations. But what is really a housing bubble? It is a time when property prices rise to unsustainable levels. This ideally means the demand of housing rising beyond the supply. At this point, the housing market becomes extremely overvalued due to artificial demand from investors and speculators. The bursting part comes when the supply exceeds the demand and the overvalued prices begin to drop sharply. What causes the housing bubble? There isn't a specific reason to what contributes to the housing bubble. It is usually a mix of the following. House building process usually takes longer, making supply to slowly respond to the demand. Uncontrolled speculative behaviors where speculators buy in the hope of price appreciation. Extremely low mortgage rates. Poor underwriting standards that might attract bad borrowers. Increased levels of house flipping. How could it cause 2021 housing crash? The pandemic has surprisingly increased the home sales, which has pushed the home prices significantly higher. In fact, the home price index showed an all-time high of $226,800 in late September of 2020. However, during this time, other economic indicators, such as employment rates and stock market, were showing negative signs. This in itself shows signs of artificial or unsustainable demand that could burst at any time. Although this may not happen instantly, its buildup and mix with other economic issues may contribute to the burst in 2021. 2. COVID-19 effects. The 2020 news feeds and headlines revolved around COVID-19. The pandemic has had interesting and also devastating effects on the global economy. The real estate industry has not been spared from the effects of the virus. However, there is a feeling that more is to come in 2021, which might have distressing impacts on the housing market. Expected pandemic impacts include: the effects of decreased real estate investment in 2020 might start to show up. Due to flying restrictions, few foreign investors were able to access the American real estate market. This decline in investment might lead to decreased demand for certain types of properties. Increased vacancy rates due to high unemployment rates witnessed in the previous year. Possible increase in bad debts. Due to increase in vacancy rates, investors might have a hard time paying mortgage in 2021. The effect of foreclosure in 2020 might come back to hurt the real estate industry in 2021. As unemployment rates soar due to the pandemic, mortgage borrowers found themselves unable to service their loans. Although the effects may take a bit longer to be felt, the 2020 foreclosures will ultimately impact the housing market in 2021. Foreclosures often means more increased supply, thus unsettling the market equilibrium and driving the prices down. 3. The rise of unregulated mortgages. A warning sign for 2007 market crash was the rising number of mortgage brokers. As brokers increased, the borrowing standards significantly dropped. This ultimately led to one of the biggest, if not the biggest, financial crises ever seen. Similar signs and warning have started to show up with the increase of mortgage brokers in USA. In 2018, the 53% of mortgage loans came from mortgage brokers, while in 2019, the number increased by 6% to over 59%. Also, 6 out of 10 top 10 mortgage lenders in that period were not banks, but unregulated broking companies. The label unregulated means these companies don't have similar financial oversights to banks. This makes them susceptible to collapse in event of small economic crisis. This vulnerability can be triggered if these companies continue offering loans to borrowers whom cannot afford a home. If these poor loans are offered in bulk, like what happened in the leading years to 2008, then the housing market might face uncertain times in the future. The signs of 2018, 2019, and 2020 are not promising considering the rising figures of mortgage organizations in that period. There is a possibility that bulk loans would have been offered to high-risk borrowers during that, artificially increased property prices and setting the housing market for an eventual collapse in 2021. 4. Possible rise in interest rates. To predict the next housing crash, one has to look at the previous ones and look at the years that preceded eventual bursts. For the 2008 crash, we have to look at the 2006 and 2007 years and look for indicators. Among the key indicators of that time was the high home loan interest rates that unbalance the scales of demand and supply. As the mortgage rates go up, it repels buyers, as now they can't afford the property. In reaction, sellers are forced to lower their prices to meet the buyer's ask. This in itself creates an instability which might have catastrophic consequences. Furthermore, increased interest rates may result to defaults and eventual foreclosures. Foreclosures then result to an increased supply of homes, which contribute to the unbalance. For this to happen in 2021, we have to look at how lenders have been behaving in the past years. Although they have been offering loans at affordable rates, this isn't guaranteed to continue. Lenders often compete with another, and it takes few lenders to set pace for eventual interest rate increase. Since they use comparison metrics to come up with interest rates, single lender might influence others to readjust or increase their home rates. If this escalation is unregulated, the 2008 pattern might repeat itself in 2021. The 2008 pattern was characterized by increased interest rates, meaning fewer buyers forcing the sellers to sharply down their prices. 5. Consumer bearish sentiment. After the 2008 crash, the housing market buyers have become more alert to economic trends. They nowadays pay attention to fundamental analysis on where the economy is heading and how that might affect the property sector. Interestingly, their feeling about the status of the market might trigger a bearish or bull market. Considering the economic situation of 2020, buyers might have a bearish sentiment on where the housing economy might be heading in 2021. This sentiment might discourage possible buyers from taking positions. This bearish state does not only affect the buyers, but also influence the sellers. By referring to the buyer's sentiment, the seller might react and decide to short the housing market at a loss. This creates an instability that often threatens the property market. If the buyers and sellers create a bearish atmosphere, lenders will also follow a similar path. They can refer to the general market feeling and predict mortgage loan demand, possible profit margins, and mortgage refinance demand. If they feel the possibility of an impending bearish market, they react by lowering the borrowing standards by reducing the set credit scores and minimum down payment requirements. Some may significantly lower their interest rates. As seen already, these are all indicators of possible market instability. 6. Faltering economy. The housing sector doesn't exist in a vacuum. It is still dependent on general economy performance. If the micro and macro economies of a country aren't right, then this is expected to reflect on all key markets, including the property market. Whether currency devaluation issues, increased unemployment rates, or bank bailouts, all these are expected to directly or indirectly impact the property sector. Although all these economic issues might impact the market, none can affect it more than the stock market. Any signs of stock market crash in 2021 might signal a possible crash. The stock market is a strong indicator of economy performance, and real estate investors often reflect on it to determine how property buyers might behave. For instance, an increase in demand for vehicles, electronic gadgets, and services often push the stock market capitalization higher. This increased demand shows that a country economy is either strong or in an uptrend. Real estate refers to this and predicts a possible demand rise in property. The vice versa of this is a possibility of stock market crash, an indicator of a plummeting economy that will consequentially impact the housing sector. Investors might see this as an indicator and start to short the housing market and protect their portfolio against the impending crash. This in itself has a ripple effect on the market by discouraging possible buyers. This might be the case in 2021, considering the pandemic effects on the economy. Due to possible economic constraints in 2021, demand for goods and services might go down, reducing stock market capitalization and threatening the housing sector. Although less probable in 2021, significant rise in inflation might threaten the housing market. An increase in inflation will lead to dollar devaluation, driving the dollar value of property assets upward. In such a scenario, the housing market might become substantially overvalued, and little currency stabilization might crash it down to its initial levels. Selling panic might also drive the market even lower than its initial levels as investors attempt to short their positions simultaneously. How should investors handle the possibility of a housing market crash? Before making a decision on a possibility of a possible marketing crash in 2021, you must first ask yourself some questions. How are homes selling in your local market? How is the home price volatility? Are the prices changing rapidly? Is there a significant number of foreclosures in the last few years? All these are questions that will help you decide whether you should short or even long the housing market in 2021. For buyers, you might also look at the above questions and decide whether it's best time to take a long position. You could also wait to see if the bubble will burst. If you are not patient enough and wish to take a position, it would be best to look out for low interest rates lenders. This case, you have leveraged your funds in case of a crash. The bottom line. If there is one thing we can all agree on, is that the housing market cycle is made up of highs, lows, booms, and crashes. What we don't know is when all that might happen. The only thing we can do is look for signs, indicators, and warnings in cases of crashes. We can also refer to the fundamental and technical analysis to see if the market is overvalued or undervalued. For a possible real estate market crash, we should look at foreclosures, domestic economic status, housing price volatility, interest rates, and mortgage broker regulations. In this article, we looked at all that and picked signs that things might turn out for the worse in 2021 if certain issues aren't solved.